And then that gets into the whole, is that good for our country? Now we're on the hook for paying, billions, if not trillions of dollars in interest payments at 4+% as compared to 2 at a time when we're running deficits.
All thoughts and opinions shared in this recording belong to the participants. This podcast is meant to inform and educate and should not be seen as solicitation or endorsement for business.
Welcome to the Market Moment. This is Matt here with John.
Morning.
And Lee.
Good morning.
I thought John was like...
all sorts of sounds.
Yeah, so we've got a couple good topics. Today is before we jump into it, today is the 300th episode. We were just trying to figure out 300th from when, and we're not even really sure. But whenever we started counting, this goes back a ways. The podcast has evolved. I know when I first got here, it was very, very, very different than how we do it today. But since we really kind of kept tracking and keeping up with it, this is our 300th episode. So
happy birthday to us.
Happy birthday to us.
Precedes me.
Big celebration. I'm sure there's fireworks going off on the screen behind us.
Yeah.
Right now.
Yeah, no, it's fun. That's a lot. We're trying to constantly make this better. We have fun with it. And so it's evolved a lot over the years. So it's been kind of fun to see, where we started. We used to use a company out of North Carolina that interviewed us kind of radio show style podcast, one-on-one. And then, it evolved into more of a collaborative kind of a couple of us on here. And so, and here we are.
300 episodes from now, will Lee and I even still be alive?
Yeah. Well,
you think about that. So, it's years and years away. We're pretty old.
Yeah, that's true.
Anyway, that's a pretty big deal
Let's
to get
hope,
to 300.
Let's hope you're at least retired.
Okay, good. Yeah. We'll go for that.
No, so that's a lot of fun. 300 episodes. Okay, so some trending topics. One that really stood out to me that people are looking at that I think is timely and just good to talk through was specific to the bond market and fixed income in general, Treasury market. 2022 is a really rough year for fixed income investors, just because it didn't do what you want it to do in a down market. The S&P was down almost 20%, and so was fixed income, right? And so it did not provide any kind of buffer or safety net in a tough market. So that was challenging for a lot of people. Since then, we've seen rates rise, by a lot. Relative to where they were at the time. And so a lot of people wondering, where are we at today when it comes to fixed income? The Treasury market is now a better time as we look ahead to have that exposure. And what are the risks and kind of the pros and cons associated with that? So, recently we had the long duration Treasury, 20, 30-year Treasuries get up over 5%, which is the first time that's happened since 2007, 2008. Right in that time frame. So it's been a long time since we've seen these types of rates on the long end of the curve. In the 10 years hovering around 4.5%. Mm-hmm. So as we look out ahead, over the coming year or two, where do you guys kind of see the Treasury market, fixed income market, and what are your concerns or thoughts?
I think it goes back to, why do you invest in fixed income? You're talking about people got slammed in 22, and then you hear, well, in 25, it was a good year in the bond market. So if you get into the fixed income, the bond market for income, now's not a bad time. If you get into the bond market as an actual investment, wanting a positive return, that may be a different story, because as we all know, bond prices and rates work opposite of each other. So at times when income is good, potentially the pricing may not be what we want, and vice versa. What is so funny, and I think we all can relate to this because we've all had our career span this length of time, nobody paid attention to the bond markets really until around 22. For 10, 15 years,
interest rates were nothing.
Interest rates were near zero. Yeah. Nobody was attracted to the bond market. And then all of a sudden, post-COVID, you began to see the return to people investing in fixed income, and now it matters. And now it matters. I mean, we've got fixed income in our portfolios. 3 years ago, we did not.
Yeah,
you know,
I mean, we didn't utilize for years. We had hardly held any fixed income in our strategies, and utilized different ways to try to manage risk.
Yeah.
And you know, and I had a client for a long time that needed income, and so we were reaching for income, for yield, and we were paying through the nose for individual bonds, you know, 25, 30, 35% premiums just to get a 4.5 or a 5% during the time when rates were near zero. Now you can go out and get 4.5, 5.5%, and you're not paying much of a premium at all.
Yeah.
You know, the bond market is really interesting right now. I know that some of the questions that we had were, is it a good time to get into the bond market? Is it a bad time? Again, I think it depends on what your need is. If it's for income, then yeah, I think it's a pretty good time to go in there and get some of these rates that haven't been around for a while. If it's for an investment,
I think if it's,
I don't know.
I think I mean, it's always hard to know. I think if you're looking for total return, then my opinion is it's better now than it was in 21 or 22.
Sure.
Right? I mean, that's kind of obvious. And so could rates move higher, impacting price in the short term to midterm? Yeah, I mean, they absolutely could. But the risk of that is not the same as it was when rates were at essentially zero.
That's correct.
Right?
Bonds
I mean,
went
you knew
down.
the only way they were going to go is up.
Yeah.
And now it's like you at least know, hey, there's the potential for rates to go down over time. And so it's a different situation.
Bonds went crazy in 2022, and I want to go back to 2022 because the beginning of 2022, and people don't remember this, but the Fed chairman had predicted and said that the very first meeting or the last meeting of 21 that there would be little to no rate hikes in 2022. And I remember that specifically vividly. And then there were 500 basis points in hikes, right? Historic amount of hikes in 2022 to combat massive inflation, which the Fed had called transitory, but it wasn't transitory, and so on. Well, bonds will get crushed when interest rates go up like that. So if you think about it, and this is simple math, but if you're holding a bond at 2% and now interest rates are 4%, that bond you own at 2 is worthless, right? If you try to sell it, you're going to lose money because people can go get a new one for 4, right? Makes sense. So that's why people that were holding bonds and bond funds, bond anything, lost a lot of money in bonds in 2022. The current market where interest rates are higher, and we think the Fed chairman, his idea is to lower rates. That's the whole purpose of why Trump put him in there. Mm-hmm. Well, whether he can or cannot is also the next story because inflation and so on is now creeping back into the story. And so inflation can keep the Fed from lowering rates. But even if they raise rates, right, which you said there's a chance of raising rates in 2027.
Yeah, I mean, the market's pricing out rate cuts for 26. Mm-hmm. And then even maybe looking at, hey, maybe a little bit of a rate hike in 27, depending on the inflation.
A little rate hike. See, this just goes back to 21 when we were having no rate hikes. So when I hear a little rate hike in 27, this is going back to oil, the Iran war, on, inflation concerns. But it's a different market today, for sure, as you said, than it was in 2022. So I don't think the fear is there. And the other thing about if you own a bond and you go buy a bond, corporate, government, whatever, and you get 4.5% right now or 5%, you can find them even better. High yields are better than that. The actuality of that, you own that bond at that rate until that bond expires, 10 years, 20 years, 5 years, whatever time frame it is. Even if rates go up and down, even if the value of that bond goes down or up, as long as you hold it to the end, you're going to get that rate of return until the end. The only time you lose is if you sell. So, I mean, I think when we look at bonds and say, okay, if we're okay with a 5% right now and that income or that we're happy with that, even if it goes to 7 and we're happy with 5, then you're not at risk. You're going to get 5 till the end. A little different than back in 2022 when you had no reason to buy a 2% bond or 1.5 because it wasn't good enough to even beat inflation.
So you guys keep talking about income, but what about someone who's just looking to, manage the risk in their portfolio? Maybe they're not looking for actual income, but they can't deal with the volatility of being 100% allocated to the S&P 500.
I think it's back in play to have it as a diversifier and avoidance of risk.
I think it is. But that goes back to my point is, one of the questions that we had was, is it a safe play? Well, I mean, define safe. If it's, can it go down? Sure, it can go down, and there's a decent likelihood that bond values will go down.
They've been volatile recently, for example.
But I think as a diversifier, for the first time, well, and let's say over the last 2 years or so, it has the return of the 60-40, portfolio is back. It has performed very well. For the previous 15 years, it did not.
Right.
I mean, it made no sense to be in fixed income as a diversifier, if you will.
Yeah.
Because you could diversify over the last, during that period of time with dividend-paying stocks.
Well, I'm only one other thing to this. One of the areas that money flows to, and this is why the 10-year or the 30-year Treasury went above 5%, which is kind of scary if you think it was the last time it did that was 2007, right before the financial crisis.
Sure.
Money flows to safety, right? So that's a sign of money flowing to safety. But are safe places to go? And I just think about this for a second. It used to be bond, or it's always been bonds, but it's also been gold. Gold is I know it's gone down from its all-time high, but it's at historical high levels. The bond market to me is more of a stable play than some of the other alternatives that you might run to in safety concerns, because the interest rates are at a better place than they had been. Even though there's volatility, even though there's inflation concerns, I still believe it's okay to use bonds as a safety net protection of some of the other money.
And then that gets into the whole, is that good for our country? Now we're on the hook for paying, billions, if not trillions of dollars in interest payments at 4+% as compared to 2%.
Yeah,
at a time when we're running deficits.
We're in this. We're in this really
ridiculous.
tricky spot with, the confidence in, our ability to pay, the interest. Like, we need rates to be, stay low, if not trend lower, to service that debt.
Sure.
But if that happens and we just keep this deficit and keep, what happens with confidence then? Does people really start getting spooked? Do people do foreign nations really start offloading treasuries? I know there's been some selling as of late. Does that drive rates higher just because people are like, hey, listen, there's a lot more risk in these than maybe historically. And so we're at this interesting point in time. I think what I like is that it's a conversation we can have. For 15 years, it wasn't worth having a conversation about because it was like, to y'all just covered all of this. But if you're going to buy something and it's not going to pay you anything to own it while you own it, and if rates go higher, which is the only direction for them to go, what I own is worth less. It's just like, it was hard to make sense to, like, you couldn't look a client in the eye and be like, hey, we should buy some of that.
Yeah.
I mean, it just didn't make sense. We're at least having the conversation now, and there's pros and cons. I think you want to stay on the shorter end of the curve.
Yeah.
For obvious reasons, because there's so much that could happen. Going out and like really making a long-term position is just, the good thing about from an income perspective is like, okay, if you want to go buy a 20 or 30 year and clip 5%,
sure,
and just say, hey, we're gonna the plan is to own this for a very, very, very long time, and you're good with 5%. Maybe that's not horrible. But if you're looking at it from a risk management allocation perspective, I would definitely be like, hey, let's keep duration shorter term, so we have a little bit more flexibility. And
different types of bonds too. We're not getting into that today. But municipal bonds, for example, they don't get as affected as fast by interest rate movements. Municipal bonds right now are somewhat attractive. The rates, it's a pretty good entry point for municipals. And municipals, you don't pay federal income; they're income tax free. So for some clients, that is actually attractive again, where it hasn't been forever.
Yeah.
Going back to our debt, look at the interest we pay now as part of our GDP. It's ridiculous of what we're spending on interest. And this is the thing that we all should be worried about. I call them drunk sailors in Washington, D.C., both parties that have been spending in oblivion for 15 years prior to 2022 because interest rates were nothing. And you could borrow and borrow and borrow and borrow and pay nothing back. Now we're having to pay for all of that because we didn't pay it off. And every time I hear that they're kicking the can down the road 6 months or whatever on a budget. It just tells you how out of control our spending is in Washington, D.C. from both parties. I'm mad at both parties. That will come to a head at some point on a macro later down the road level that could cause more deterioration in the confidence in our
Correct.
I mean,
US
so
deal.
this was just a quick search, but government spends approximately $1 trillion annually on net interest to service debt. This cost represents roughly 14 to 17, call it 15% of total federal spending, making the interest payments the third largest government expenditure behind Social Security and Medicare.
Yeah, that's not good.
Hashtag America.
America. That's
that's-
not a good thing.
Yeah.
I mean, now go back to 2021, and that was much less on the same amount of debt, and that goes back to interest rates being much higher now than they were then, and so that's on the negative side. Anyway.
Real quick, so that's actually the only anything else that you guys wanted to talk about before we move on?
This is interesting, and I saw the headlines yesterday, and then I read a little bit about it this morning. The Pope making comments about AI. Have you seen that?
I did see that.
You know, this Pope has not shied away from entering into politics,
All
and
kinds
now,
of things.
and now
Yeah.
business.
Yeah.
It's probably because he has a Robinhood account and he's trying to.
You can see in the background when he's
we
talking.
need to disclaim that. Oh my word! Anyway. I just think it's interesting that this craze that we're going through right now.
Oh, yeah.
Has now
reached
the Vatican.
exactly
Yeah, it's
AI
interesting.
craze.
But
Yeah, I mean, we were looking at like SanDisk and Micron and some of these. It's crazy what's gone on over the last 6 to 12 months in some of these names.
we've talked about this before, but I am still blown away by the resiliency of this market.
Me too.
We're 3 months into a war. No oil is rolling through the strait right now. Now oil prices have come down, and we've got a market that is.
This is confusing for a lot of my clients and a lot of American investors.
It should be.
We are energy independent, which means we get all our energy from the U.S. And it's another frustrating thing about government and everything else. The Strait of Hormuz, 20% of the world's oil goes to Asia and Europe.
Yep.
Yes, it affects us with imports and so on. I get that. But this idea that every gas station has to bump up gas prices like this, it should make us all mad. We are energy independent. That means we produce the energy enough to supply our energy for our people. Why does it matter? And I get the idea that it does matter on the imports and all that, but that's months and months and years away before that really impacts. It's very frustrating. I know it's frustrating to anybody who just thinks logically about that. The Strait of Hormuz is big to get that open for the world. We need that done. But the U.S. is the overpricing to me is just, and I hate to use the word greed, but it's like it doesn't make as much sense.
I don't understand it well enough, to be honest.
It's greedy to me.
It doesn't make sense on the surface.
It doesn't make sense on the surface, yeah.
But okay, real quick plug. Eli's actually recording a new data brief today that'll be going out Friday. So be sure, if you don't keep up with Eli's data briefs, really good information. Think he's talking about some retirement spending withdrawal strategy stuff today. So be on the lookout for that coming out.
It's good data
Friday.
and it's brief.
Yeah. Thank
Good
you,
name
John.
for it.
Thank you, John. All right, we're going to end with, so today's episode is a little shorter, but we're going to still end with a handful of questions. I've only got 4 questions for you guys.
Love it.
So 4 quick questions.
Here we
a few
go.
of these are a little more like serious, like market,
Serious
economy
questions.
related, and then a quick sports one at the end. So
Okay.
don't ask any clarifying questions
Okay.
because I can already see where you guys are going to take this. Okay, will the national debt be a problem in the next 5 years?
Yes.
No.
Will Social Security end up getting cut in the projected timeline?
No.
That was both of us. No.
Yeah. Okay. Over under 3 years for S&P 10,000. It's roughly 33% higher than where we're at today. Gosh. 3 years.
Over.
I'm going to say under. I can't fathom we keep this pace for this.
Whoa,
Then you would say
over under 3 years. So
I'm
for
saying
S&P,
I'm saying over.
meaning like, will it take more than 3 years to hit?
Oh, yeah. Over 3 years. I'm sorry. I thought
Yeah.
you said it was going to.
Okay.
Yeah.
Y'all
sorry.
are so bearish. It's unbelievable.
No, it's not. It's not bearish.
kidding.
It's just.
I mean, that's 30.
I'm the resident bull.
You are.
No. Okay. Over under 3. Okay. So 10,000. You think it's going to be more than 3 years out? Okay. And the last one, Razorback baseball. Do we make it out of Lawrence?
Yes.
We do one way or the other. Either we're coming home. I don't think they're going to get stuck at Lawrence. So yes, they're going to make it out.
For all of our
think so?
for all of our Kansas clients.
Hey, this
and
is
listeners,
controversial
Lawrence
though.
is a great place.
I know that I may be a hog homer, but we made it to the finals of the SEC. We had a pretty good RPI. We had a pretty good season. We were ranked 12th in one of the polls before the SEC tournament.
One loss.
I think we
one
got-
loss early in the season did us in.
Just that one to one of the bad teams. Yeah, we had some bad
Stetson.
RPI losses early.
We had 2 losses to Stetson. And
Yeah, you're right.
That
You're
was
right.
it.
That probably is it. But I look at the 16 teams above us. I'm like,
Can't argue that.
So
One-
yes, I
one
think we
loss.
make it out of Lawrence.
All right. Where would we go? I mean, do we know where
We played number 2.
It would be Georgia Tech.
Yeah, Georgia Tech.
If they win their region.
And they're only good at 2 things: hitting and pitching.
Okay. Yeah.
So they're pretty good.
Yeah, we're in trouble.
And fielding. They're good at
I
fielding.
agree. I think we make it out of Lawrence. I think I'm answering my own questions now. I think it's under on S&P 10,000.
All right.
No on Social Security cuts. And will national debt be a problem? Obviously, it depends how you define problem, but I would say yes.
And see, you wouldn't allow us to say that. And I was going to say,
But I
how
make the rules.
Yeah,
You do. So I get to.
He got to elaborate, Lee. Did you say that?
And okay, so since you got to hedge, I will clarify. I don't think it's going to be a problem because I think our GDP continues to grow substantially to where it's not.
I hope that's the case. I'm on that as my dream.
Yeah.
All right.
Good question.
Let's all hope. Okay.
Yep.
Well, as always, we appreciate you guys watching, listening. Give us a like, subscribe. Let us know if you have any questions or any topics that you want us to cover on an upcoming episode. Be sure to check out Eli's Data Brief coming out this Friday. We look forward to seeing you guys next week.
Have a great week.
The hosts of the Market Moment podcast are employees of Mach 1 Financial Group, LLC. Mach 1 is a registered investment advisor located in Rogers, Arkansas. A copy of Mach 1's current written disclosure brochure is available through the SEC website and available at disclosures.mach1fg.com.